All right, good afternoon, everyone, and thank you for everyone who's logged on today for our national market update. We've got David McMillan, one of our directors here today, who will be running the presentation. We're also recording this presentation today, and we'll send around the link to the recording over the next couple of days once we have that. But welcome, David, and thanks for running the preso. I'll hand over to you.
Thank you, Paul. Okay, so just a general disclaimer today, guys. This is not personal advice. This is general information only. If you want some specific advice, please reach out to one of the qualified property advisors. For those of you that don't know me, myself and Philip Almeida started Performance Property over 10 years ago now. Qualified real estate agent, property valuer, and also property investor, most importantly. So that's the experience that that I'll share with you today. So for those of you who tuned in frequently to this, the message is going to be very similar. So this probably won't be a very long one because it doesn't need to be. The message is still very simple. And the message is that we haven't been building enough. And what we're seeing here is the vacancy rates across the country. And when we look at the vacancy rates on a regional level, it's the same, or in some cases even worse. So there's not enough rental stock. Rents are rising, and you'll see in the coming slides that rents are rising everywhere. And in some cases, they're rising aggressively. So I think what this slide tells us is that there's a downward trend to vacancy rates that started in 2018, and we expect that to continue into the future. Here's the price differences, the price changes from May 2020. May 2020 was when COVID hit, and as you know, the media, the reason why we show this slide is the media were predicting price falls, -20 and in some cases -40. And so the message that I always share with this slide is just be careful who you listen to when you're making your property decisions. Our information comes to you direct from, so that our views come direct from the data. We spend $500,000 a year researching the market. You're seeing part of the benefit of that today. We're unbiased, and we try to call it as we see it because obviously we value our client relationships. This is another slide that is evidence that we are still not building enough. So there's a downward trend on building approvals or dwelling approvals, and that's been the case. This is national, obviously. That's been the case since 2015, 2016. So that shows up in the vacancy rate. There's not enough rental stock to go around. That's because we're not building enough. And when you combine that with the very aggressive overseas migration that we've had, we're starting to see some strong commentary in the media about this rental crisis. We've been talking about a rental crisis brewing for a while. It's now coming to light. Our dialogue probably 18 months ago was, when the interest rate discussion fades, what we'll be left with is a severe demand exceeds supply event that will result in rising rents, and that's certainly what we're seeing now. So you can see the light blue here is the overseas migration numbers, and they have almost been double in 2 consecutive years what they were previously, making up for that COVID period where we certainly didn't get our quota. So that's putting strain and pressure on the property market, as well as a lot of other industries, as well as on inflation generally. Okay, so we're going to start with Sydney, because Sydney is the most interesting at the moment for me as someone who's been researching the market for 10 years, and it's the most interesting for us as a business. Sydney is such an important market to track because it leads the market. Sydney sets the high watermark for the country. At no point in history has any capital city market been higher than Sydney. And so Sydney, once it peaks, will set a high watermark for the country, and then all the other markets rise up to Sydney. That's typically how things have tracked historically. What Sydney is experiencing now is an unaffordability issue that they've never experienced historically, as far as the data goes back, as far as we can get it, because we can't get it back earlier than 1980. In the 1980s, late 80s recession, the affordability index was over 60. And what that actually means is 60% of the average wage will go to the average new mortgage. Okay, so we're talking about the average person in Sydney. If they have a 20% deposit and they're entering the market now, 60% of the average gross wage would go towards that mortgage. And what we've found over time is that every time the Sydney Affordability Index gets to 60, and hopefully you can see this, the market corrects. So the black is the affordability index, the black bar lines, if you like, or bars, if you, however you want to describe them. But the blue line is the year-on-year price change. So when you get an event where Sydney's unaffordable, which is above an affordability index of 60, you typically see the price come off. So you saw it in 88, 89. We saw it in 2004, prices came off. We saw it in 2008, prices came off. We saw it in 2012, prices came off. We saw it in 2017 and prices came off. So when Sydney hits an affordability index of 60, there's a consistent pattern of prices going negative in the years following. What we've seen recently with these 14 interest rate rises is the cost of debt has risen so fast, so quickly, that Sydney's affordability index is now where it has never been. It was high at 77. We didn't think it could get higher, but and I checked this information last night with Saskia, who's running our research department, that the figures were right, and they are right. 87% of the average wage will go to the average new mortgage in Sydney. And obviously that's not possible because that's the gross income, and you got to take out tax. So once you take out tax, there's only 70% left. And if it was 70%, then there'll be no money to live on for single income earners. And there's a whole debate around that, you know, we've got dual income households and et cetera, et cetera, et cetera. But I think what we're looking at here is a market that is incredibly unaffordable and possibly only functioning on intergenerational wealth. The bank of mum and dad is rife in Sydney, and at some point that has limits too. And I think those limits right now are really being tested. And I've heard stories about the bank of mum and dad not only stumping up the deposits, but now starting to make the repayments. And that's a significant issue. So when we look at Sydney from another angle, we look at it from a price to income. So this is the average house price in Sydney versus the average income. You can also see that it's incredibly difficult to save a deposit in Sydney. So if you're making 100 grand, the average house price is 1.4 million. Even if you're putting 20% of that away, it's going to take you the better part of 10 years to save a deposit. So it shouldn't be functioning right now. It surprises me that in the last set of data and the rolling 90 days, it went up. In fact, I couldn't believe it went up. And I just think it's in very dangerous territory to become quite volatile on the downside now. So it's not saying that Sydney can't continue to go up because anything's possible, but we are certainly watching this market as the next market to potentially buy into when it starts dipping, which it should. Now, we don't know that it will. We haven't got a buy rating on Sydney. We've actually got a Sydney in a downturn, but it's just so fascinating to watch right now. What we're looking at here is the difference between Sydney houses and units. Now, one of the issues when houses become chronically unaffordable is people in Sydney have options if they're looking for accommodation. If they can't afford a house, which most people won't be able to afford a house, certainly without assistance, their options are to rent, to buy a unit, or to leave Sydney. And what's happening at the moment is all of those things. So we've been watching the Sydney unit market as a potential value opportunity for us, for ourselves and our investors, which we haven't pulled the trigger on. It's more of a watch alert at the moment, but it's certainly a market that we're thinking about potentially entering into. And when I have clients come to me thinking that, they want to buy a Sydney unit, we're not standing in their way. We're saying that could be a reasonable idea based on the gap between Sydney houses and Sydney units, and the fact that the market is chronically undersupplied, which is evidenced by this graph here, which shows the vacancy rate going down and the rent in Sydney rising aggressively. So from 2020, from COVID, the rent in average house in Sydney was 638. Now it's 1,020. So that just gives you an indication of how undersupplied that market is, and how much pressure is in that market right now. So it's an interesting time to be watching this market. Just to go back a couple of slides, We actually thought the high watermark for Sydney was set at 1.32 million, but on the rolling 90-day average, it's gone up to 1.37 million. So what that suggests to us is that every other market around the country has the potential to come up to that figure. And so we're watching that figure where it's going to settle. Our forecast for Sydney is pretty pessimistic, and I think you'll see that in our forecasting slide down the track. But the significance of this 1.3 number is during this cycle, we don't think any other market, including Melbourne, will actually get past that 1.3 number this cycle. Okay, I just want to stress that everything moves in cycles, and we're sort of at the tail end of one as we speak. All right, so we'll move on to Melbourne. So by contrast, the Sydney Affordability Index was in the 80s. Melbourne has an affordability index in the high 50s. And Melbourne is, it's unaffordable. We're looking at Melbourne thinking that it probably will rise next year on a sliding cash rate. So the cash rate comes off. That has a dramatic impact on affordability because affordability, a large part of affordability is determined by the cash rate. So if the cash rate comes off, affordability will drop into the high 40s or low 50s, and the market is not as undersupplied as Sydney, but definitely undersupplied, and therefore we might see some positive price pressure on Melbourne houses coming into 2024, 2025. But it's if the cash rate doesn't change, if the cash rate remains where it is, expect Melbourne to maybe soften a little bit or go into a bit of a holding pattern for a little while. By contrast to Sydney, it is easier to save a deposit. So the average house price is 9.2 times the average income. So, it's probably going to take half the time to save a deposit for a new home purchaser. So it is a little bit more affordable. We can see price growth on a sliding cash rate, but it's certainly not somewhere where we're directing investors from a value point of view. Also, like Sydney, the Melbourne rents are on the way up, both in units and houses. And when you see this, it tells you that the market's undersupplied, which confirms the story that we're not building enough. But one of the backdrops to a rising rent environment, which we are definitely in, is you typically see a cycle in units. So we are investigating units at the moment as a possible value opportunity for clients, not as a long-term buy and hold, but more as a trading asset. We've never done that before, but the market's sort of forcing us to look for value and be creative and still add value in those annual discussions we're having with clients. So it is possible that we see a bit of growth in Melbourne houses next year on a sliding cash rate, but a moderate to possibly a significant amount of growth in units on a sliding cash rate in Melbourne next year. And what will drive growth in units is a sliding cash rate, but also rapidly rising rents, not only in the housing sector, but in the unit sector. And that is true of the whole country, right? So when you have a rapidly rising rental cycle, you typically have a unit cycle that follows. So we're expecting that not just in Sydney, not just in Melbourne, but all markets around the country. I haven't passed any commentary on Brisbane and Adelaide. Those stories are very similar to last time. I'm happy to take questions on those. We do have a forecast on those, but I wanted to spend the most amount of time on the most significant opportunity from a residential value perspective, which is Perth. For those of you who have been following us for some time, we entered the Perth market in 2019, which by luck or by skill was the bottom. We've bought in excess of 600 properties there now, pushing 700 properties. We'll probably buy 1,000 properties. I think 2024 could be the last year that we have the opportunity to buy in this market. And this market, when it gets going, is typically the most aggressive. So let's look at affordability to start. Perth has the best affordability in the country and is still very affordable with an affordability index of 35. So even with interest rates where they are, the Perth market is very affordable. And typically when you look back through history, Perth rises pretty well in a rising interest rate environment. So the first thing that we look to when we feel like demand exceeds supply is it affordable and is there a run coming? The market is without question affordable, and on a sliding cash rate, it's even more affordable. When we look at it from a deposit saving point of view, first home buyers are so critical. Their participation in the market is so critical because if you've got the first home buying market thriving, you've got the investor market keen to wanting to buy, and then you have upgraders upgrading and everything's functioning. Typically you have FOMO and a bit of euphoria. So how difficult is it to save a deposit in Perth? Sydney would take 10 years, Perth would take probably 3 years. the average house price to the average income is less than 6. So first home buyers can access the Perth market, don't need the bank of mum and dad, can do it on their own steam, and are doing it on their own steam. And we are in competition at the moment in Perth with everybody you can imagine: first home buyers, upgraders, dream home purchasers, investors, out-of-state investors, local investors, etc. So we're happy with the money that's been positioned to date, but we're trying to get more in before the market really does take off. This is the Perth cycles back to 1980. You can clearly see the periods of growth and stagnation, and you can clearly see how aggressive prices do rise. I'm not sure how clear that's coming up on your screen, but if we go back to 1988, house prices went from $30,000 to $90,000 in the space of 4 years. So they tripled in 4 years. And that speed of growth is phenomenal, especially if you're inside that market. Like, properties rising in today's dollars by, 10, 20, 30, 50 grand a week, depending on your price point. So we're preparing ourselves for that next year. We don't want to be coming second or third or fourth or fifth or 10th. We really want to be coming first most of the time. So we're gearing up our buying team to be across where to be positioning price next year. But you can see after that rapid growth in the 80s and early 90s, we had a period of stagnation, and then another period of very aggressive price growth where prices went from circa $150,000 to $460,000 in around a 6-year period. So since then, since 2008, 2010, the market has been on a relative stagnation. So you can see here 2010 to 2020, the market didn't move at all. And so we've had a decade of nothing. During that decade of no growth, we didn't have a lot of development activity because developers couldn't make a profit. So what happens, the oversupply that was produced last cycle is gradually absorbed. That is then moved into a neutral supply on natural increases. That sort of gets to a point where there's an undersupply and then eventually a chronic undersupply. And a chronic undersupply is where we are now without question. And we're seeing that in the rental growth, which I'll share with you now. Rents have gone from 439 to 742. So almost doubling since COVID. The vacancy rate is the lowest in the country. Our properties in Perth, 99% of them are rented within hours, if not 48 hours. So it's a market where demand dramatically exceeds supply. It's a market that's incredibly affordable, and it's a market that's probably going to reset to a price point somewhere similar to the East Coast. Historically, the Sydney median house price, the Perth median house price will make its way all the way up to Sydney's. Now, Sydney's at 1.3. and the Perth median house price is sitting at 605. So there's a long way for it to go. There's still a significant opportunity there, and I'd encourage anyone on the call who is thinking about it to, if they have the capacity to do it and have a cash buffer, to put it in their portfolio, and obviously speak to one of your advisors before you do so. There's also an opportunity in Perth units. You can see last cycle, Perth units rose just as aggressive as housing. Perth is not a market that we buy and hold in. We don't buy in Perth and hold in Perth because it is so boom and bust. But we are opportunistic about getting in and getting out, which is the play for most clients. If we can use some easy money just because it helps me. Let's say you get in for $1 million and we sell for 1.7, you're probably going to net 500 after your CGT. You're going to grab that chunk of 500 grand and then you're going to pay it off debt somewhere, and that will help you push your portfolio to the next level. The good news with Perth is it's probably going to happen quickly, unlike other markets where sometimes we've been a little bit early and sometimes we've been a little bit late. This one, we think we're on the money, and it should be a very quick upswing when using history as a guide. The other compounding factor about Perth that makes us feel like we really are in the sweet spot is when we first started buying in Perth, there was circa 20,000 houses for sale. Average days on market was floating around that 50. This is back here in 2019. And then since we've been buying, both stock on market and days on market have been reducing, particularly in the housing sector. And if you go onto realestate.com now whilst we're talking and you do Greater Perth and you search for houses, and you tick every property that's under contract or exclude every property that's under contract, you'll find that there's only less than, maybe, don't quote me because I haven't done it in about a week or so, but maybe about 4,000 houses for sale. So Perth has the most demand per capita per person in the country, and we've got some demand scoring that we might share in our next webinar that we've been refining over the last 12 months. It is where all the pressure is. It is where the affordability is, and we are all buying there, including our staff. What's driving the demand and why it will be sustained is job vacancies. People don't go to Perth for fun; they go there for work. What we're seeing at the moment is, obviously reasonable natural increase, but very, very strong interstate migration and very, very strong overseas migration. And if you look at the other end of the spectrum, you look at Sydney, it's losing interstate migrants because of its unaffordability, and Perth's gaining interstate migrants because of A, the work, and B, the quality of life that you can get, because things there are still cheap at the moment. So, how long is this boom going to last for is the question, and when do we get out? Is probably the hardest question that we have to answer moving forward, but we're obviously going to be tracking it every month, and our clients are met with once a year minimum, sometimes twice a year, and that's the forum to have those conversations with your advisor. When we look at the markets as a whole, this is the clock for housing. You can see, you can see a visual of how we're thinking about everywhere. As I said, we do have significant positions in Adelaide, and we do have significant positions in Brisbane. Both those markets are definitely past mid-cycle, but definitely have more to go, especially on a falling cash rate. Both those markets are chronically undersupplied. Both those markets are experiencing strong rental growth. If you've got property in those markets, you'll know what I'm talking about. There's nothing to do there other than to hold and to make sure you're having those annual catch-ups with your advisor, because there will be a sell opportunity, a sell window for those of you that it makes sense to sell for, coming most likely 2025, 2026. We can't say exactly because we're monitoring the data every month, but we're anticipating that those markets should be somewhere peaking in that range. And if you did want to sell, take some debt off the portfolio and use those net proceeds to pay down more debt, that would be the time. You can see that Perth is off the bottom now. It's on its way and should do fairly well. We're also taking positions in Mandurah, Rockingham, which is now south of Perth. That market entry point's about 500k now, and also Rockhampton, which is in Queensland. So this little cluster of cities and towns on the map is where we're focusing all our value buying activity for investors. When it comes time to looking at units are important, especially now, because we are going to see growth in units. You can see there's far more opportunity in the unit market, far more markets positioned for growth. We are buying Perth units because Perth units do buy aggressively, and it's not a buy and hold strategy. So that allows us to participate in the market at lower price points for our clients. And if that is of interest, that bet should also do quite well in the next medium term, next sort of 3 to 6 years. So again, don't think because you can't afford a house, you might not be able to participate. You can. It's Perth units, and that will be the play for 2024. Now, we're obviously in the business of trying to understand where the market's going to be, not where it is. So we're doing some forecasting, and the forecasting here is we can't forecast where the market's going to be without understanding the demand supply balance, but also understanding where the cash rate's going to be. So we don't know where the cash rate's going to be. We feel like it's peaking, but we're surprised that it's this high, right? So what we do know is in the short term, anything can happen. So we're giving a cash rate range, and then we're ascribing, what percentage the market might move depending on where the cash rate settles. And as you can see, we'll take some extremes. If the cash rate got to 5, money would be lent at 7.25, and we feel that Sydney could fall 30%. And I think that's one of the reasons why the cash rate won't get that high, is because they don't want severe instability in the Sydney market. I know that's not how the RBA think directly, but that would play in the minds, no question. And Perth still would be able to rise 54%. So that just shows you how powerful that market is, because even if we put in a very pessimistic cash rate, we can still get a really meaningful investment outcome. On the flip side, the investment committee feels that somewhere in the medium term, the cash rate should settle back towards 3. And if it does, Perth's got 90% in it, and Sydney's only going to have a modest softening. right? And then we've got every market in between. And if you need to take a photo of this so you can digest it later, please do. Paul will be managing the Q&A. So if you've got questions, you can put them in the box and we can come to all the questions at the end. That's the end of residential. So we'll start on commercial. So the commercial market's been really, really tough the last 3 years for us to buy as a business, primarily because when the cash rate went almost to zero, a lot of money piled into the commercial markets and drove the yields down, so much so that there was just no value in the market. So, you know, what that has resulted in 2023 is a commercial market that in a lot of sectors is overvalued. And so it's very difficult to transact because we don't want to buy stuff that could go down and we don't want to buy stuff on low yields. The 400 basis point increase in the interest rate hasn't really had a dramatic impact on yields improving. It has had some impact, but not a dramatic impact on as much as we'd like. We think that hopefully we'll see some of that play out next year, where we might be able to buy quality assets on 6% yields. We're happy at 5.5%. It's just so hard to achieve. We're happy trading on net 5.5% yields because long term, that's historically been a pretty decent rate to achieve a return on your money, considering that your money is also indexed to inflation with a commercial property because your rent moves with inflation. At the moment, though, quality defensive commercial properties trending between 4.5 and 5.5. And there's very low volumes going through the market because people aren't forced to sell and people don't want to buy. So no one's doing anything. Right, which isn't great for us because we make our money when people transact. But we're a pretty resilient business, and there's many things going on. So recommended commercial strategies. We are advocating that people, if they do have a long-term strategy with their business, buy principal places of business. If you speak to your accountant, they'll likely advise that is done in a super fund because you can shovel more money into super. We have that service in-house. We have done many of these for clients in the past. We'd love to do more of them. We are still buying passive defensive income producing assets on a 5.5% net yield, subject to everything else stacking up about the asset, which is very, very difficult to achieve, incredibly difficult. I would say that we are analysing 100 properties and maybe buying one or two. It's a very difficult market. We do like medium-term development sites, so we've bought a number of sites with commercial income on it that has medium density development. And the reason why we like those sites is because apartment prices must rise in this chronic undersupply. And when apartment prices do rise, these development sites become more valuable. So the market should be aware of that, but it isn't aware of that consistently. And so we have had a lot of opportunities to buy development sites on what we feel are very good prices. And we're engaged in strategic partnerships. A lot of those strategic partnerships are confidential. They'll come to light next year in our funds management business. But that's how you generate value when the market doesn't organically produce it. You have to go out there and create value. And Ryan Mitchell from our funds management department has been working really hard on that in the last 2 years. And next year is probably going to be a big year for us. So the summary, and we will open up for questions immediately after this. Hopefully there are a few, is that rising interest rates will produce headwinds across the country to all markets. I mean, that sounds obvious, but it is probably the number one issue in the market at the moment, closely followed by the chronic shortage. But until we get some interest rate relief, we won't really see any fireworks going off with respect to price rises. But when we get some interest rate relief, the fireworks may quickly follow because the market is so undersupplied and there's going to be a bit of FOMO, particularly in the markets that we've been recommending for clients. The undersupply is highly likely to get worse because even if we had a solution today, which we don't, it would take 2 to 3 years to be built. So we don't have a solution, and it's going to take 2 to 3 years when we've got a solution. Will we ever get a solution? I don't know. I mean, we must get a solution at some point, but that is in our favour as investors because we know the backdrop is the market has to be very robust. Incomes on those assets will rise, and therefore, where there is affordability, those asset prices will rise. And we're looking forward to that growth in the short term. Good opportunities to acquire residential growth assets. Now, I hope I've demonstrated that by showing you some of the information that we've shared with you in Perth. That information is the same with Mandurah, with Rockhampton, with Rockingham. So I would encourage you to review that and think about that. I don't think we're going to find the same value in 2025. I think 2025 is going to be a very difficult year for us to be placing money from a residential point of view. So if you're thinking, I'll put it off a couple of years because of A, B, and C, this is probably the best time that you're going to see in the next 24, 36 months to get some money in, so it's working hard for you. And there might be personal circumstances that's preventing you from doing so, but maybe you do something now rather than something bigger later. Would be the message that I want to leave you with. Most clients should continue to hold existing growth assets. So Brisbane, Adelaide, Ballarat, Bendigo, all those markets and Toowoomba, all those markets that we were mopping up in the last 3 years, they are still set to do really well because they are still undersupplied and the cash rate should come off, growth should come back, and there'll be a selling window in the future, which isn't now. So if you can hold on, please do. Those clients are moving less than 10 years retirement. We are beginning to shift away from a solely growth-focused portfolio, and now we're moving towards a balanced growth and income portfolio. And for those sophisticated investors, that comes in the form of commercial funds, which we've been talking about, but we'll talk a lot more about. And it comes in the form of commercial property as well. You can't really generate strong income from residential property as a primary investment vehicle. So we've, over the last 3 years, aggressively pivoted down this line to cater for our maturing client base. And we look forward to giving you those options as the years progress. Questions? Paul, I'll hand it over.
Thank you, David. And just for everyone's benefit, I did do a quick fact check on Perth houses. 3,931 for sale right now. So you were right, just under 4,000. Well done.
That makes me happy.
Jason has asked a question there, just in relation. He's working in Sydney, looking to buy their first home. The question's around, is now a good time to buy or should they wait? Obviously, it's fairly unaffordable at the moment. Now, just as per the disclaimer, it is really hard to give out advice. We'll have to keep this general, but maybe if David, you could also maybe take us through the process that we'd go through in an advice meeting to maybe make a recommendation around that question.
So the question is, should I buy a house in Sydney now? Is that right?
Yeah, that's right. The first time.
Well, I think it's always been a tough question for someone when their market that they live in, where they want to buy a home in, is at the top of the cycle or in a downturn phase. And the simplest way that we've had a framework for dealing with it internally is, if you can comfortably afford that home and you can see yourself in it for more than 10 years, then it's probably going to be a good decision, because you're going to ride through the cycle and have the emotional benefit of obviously living there and not being, managed by landlords and condition inspections and stuff like that, right? So, and if you can't comfortably manage the repayments and you can't be in there for 10 years, then it is most likely that it's more suitable for you to rent in Sydney, and invest in the markets where there's going to be value. There is a halfway option in Sydney at the moment. As I said, we do see value in the Sydney unit market. So maybe if you can buy something in the Sydney unit market that suits your needs for 5 years, that could be an option. But it depends on the family dynamic and how that's all going to unfold.
Jason, hopefully that answered. I mean, obviously you're welcome to reach out and have a chat with your advisor as well to go into more detail on that one. Scott, as mentioned, so we purchased the property in 2019 in Perth. It's gone up around 50%. Does your research presented today indicate there's a decent chance this has another 100% or so growth left in it?
I think just Scott got in at a great time, and he's probably going to be really happy at the top. I mean, the thing is, it was quite difficult to convince people to come into Perth in 2019 because the data wasn't great. And Scott had a couple of really positive experiences with us previously. And so he had the courage to come with us early because the data was not this good early. And so he just got in at the bottom. He's got some really good growth, and we think, as you saw in those forecasts, that the market's got another 50 to 100% in it, right? So Scott, we're just going to have to deal with that on an annual basis. But it could be that, yes, there might be another lump of 100, but I don't want to I don't want to sit here and say that's definitely coming. It's there's still enough in it to keep buying right now, and I would expect another 50% for the market to reset to where replacement cost is.
Okay, thank you. Pooja has asked the best way to get a property valued. They bought with us in Perth in June this year, so just wanting to understand how it's going. So we have an annual review program that we run that all clients should be getting emails to book in for an annual review with their advisor. So usually that would happen around June next year, where we do an appraisal for you, Pooja, and we obviously would work with, or your advisor would work with you in looking at any equity there, and obviously help you with any decisions from there. And I think that is it in terms of the questions. So one thing that we are looking to do, we run these quarterly. We find that quarterly is a good frequency, but we are looking to gather feedback from clients, and we possibly will be looking to send out a survey to clients that have been attending these, just to get some feedback on the format, the frequency, and those things. So when you receive that, possibly in around February next year, it'd be great to get your feedback, help us improve the data and the presentation that we're presenting every quarter. But I think apart from that, we'll get the recording out to everyone over the next couple of days, as I said. Hopefully everyone has a great break over the holiday season, and we look forward to seeing everyone at the quarterly update, which will be in March, and that's up on the website. So thanks again for everyone who's attended, and have a safe holiday season. Thanks, David.
Thanks, Paul. Thanks, guys.
All right, thank you.